Hello, everyone, and welcome to the NASDAQ Dorsey Wright podcast for the week ending on August 5th. My name is Ian Saunders, and we are joined today by Steve Raymond to dive in to a discussion on some of the recent kind of model updates that we had coming out this week. We had movement last week kind of wrapped up the month of July. We headed into the month of August this week, the kind of last historic summer month, right? Which also led to the evaluation of many of the models that we have across the Dorsey Wright platform. So for those who might not be familiar with the platform as much, or just kind of following along the podcast side of things, we have the research platform, which has a variety of different model solutions that are available. Now, these are going to be paper models, so we track these models on the platform, and then anyone who is a subscriber to the platform can get alerts to changes in these models to make as they see fit. We have many different kinds of models that are available on the platform, and the ones that we're going to be focusing on today are what we call the FSM or Fund Score Method models. Now, these models are a little bit different than some of the other models that we have on the platform. We have matrix-based solutions that look at strictly relative strength comparisons to get at the model holdings. The FSM models are a little bit different. They do incorporate relative strength, but they do so via the fund score. So the fund score is a scoring system that we use for ETFs and mutual funds, which is going to go from 0 to 6, 0 being the worst, 6 being the best. So then a brief kind of run through of these models, just to give some backstory. Basically, what we're looking to do with the FSM models is take an inventory of funds and then simply rank that inventory of funds by that fund score, 0 to 6. 0 is the worst, 6 is the best. Just rank that inventory at set evaluation points to see which funds in the inventory are scoring the best. And then we maintain exposure to those funds after that model evaluation until the next model evaluation. So just a couple points that kind of differ these models from other areas. They are the set evaluation points, which are typically either going to be monthly or on a seasonal quarter basis. Now, quarterly, still 4 times a year. But with these models, we're looking to capitalize on the market seasonality aspect. So they'll sell in May and then come back in November, kind of utilizing off-calendar quarters. So it's the model evaluations are going to be the beginning of the month of February, May, August, and then November. So we just had the latest model evaluation for the month of August. The models were evaluated based upon market close on Wednesday, August 3rd, and then trades were going out there to the broader client base the morning of August 4th. We're recording this podcast the afternoon of August 4th. It's going to be released there on Friday, August 5th. But just to give people a feel here, Steve, I mean, these are different kind of models than those that we have other aspects of the platform. Where I know you played a major hand in the kind of origin of these models. So why did we start kind of looking at these relative to some other, just a straight up matrix solution?
Yeah, that's a good point. Some of the originality of the fund score based solution is that score also pays attention to trend, not just relative strength, and other attributes, moving averages and other technicals where we sum those up, and it gives a vibrant difference between different funds, and that was needed back in the origin of the fund score method, because really principally we dealt with mutual funds, 401ks, huge lineups of mutual funds and how to distinguish between them versus other rating systems that one might have used or could use. We found that the fund score method is fantastic with the mutual fund universe. Of course, the ETF universe, as it came on later, back in 2002, 2003, the ETFs behaved the same way. So really the fund score method is a wrapper for mutual fund ETF-based, or you could say ETF-based and mutual fund-based solutions, and for those people that need that type of inventory to be managed. The matrix in those days could only handle, let's say, 50 or, and then later 100 observations of inventory, whereas the fund score method can handle, thousands of observations and looking at inventory. So it was more flexible. And that's why I think that, we started to use it. And I think that's why some people stick to it the flexibility of being able to measure all kinds of things through that product gives it a little bit of a logistical advantage. The fund score, helps us, really rank any fund, and then really, we notice that if we work on a monthly or seasonal basis or quarterly basis, it does very well, and certainly fantastically well in trending markets, but it does pretty well in markets that change a lot of directions intra-period or in close proximity to periods like monthly or so forth. So I think that we built models, we've taught them in seminars for many, many years, and we have them on our website in these years. And I think that there are some advisors that lean towards kind of the speak, the nomenclature, and the fact that the system was designed around funds, with that type of sensitivity versus, let's say, a system that was originally built around stocks. So there is a little bit of a breed, difference. It doesn't mean it's meaningful. It just means it's comfortable for certain clientele to use the fund score method.
Yeah, and I think that's a good point. I mean, it's not that one's better than the other, right? They're just different. They're catered to different kind of use cases. And I think that fund score application of it, I mean, it's a relatively easy system to understand, right? I mean, you have a score 0 to 6. 0 is the worst, 6 is the best. Try to hold the higher the funds, the better, right? I mean, that's a kind of easy system, at least for maybe the uninitiated, maybe we'll say, to kind of get a grasp on that concept. And I think another aspect of it that has been pretty popular with some of the clients, at least I've spoken with recently, has been the ability for the models to move defensive or to move to cash, right? I mean, so each of the fund score method, each of the FSM models we have on the platform has the ability to go into cash, some in a couple different ways, all of them in at least one. I know that we do include the money market, our 13-week T-bills, our cash proxy here on the Dorsey Wright system. We include cash as a member of each of the inventories. So if cash rises high enough in the rankings, the score rankings, then it could potentially move into the models. And then some of the others utilize the secondary cash trigger, which comes in a few different fashions there. I know those look at the ranking of essentially our cash proxy ranking and a broad U.S. core equity ranking to get at what we call the PR 40/50 trigger. And so, Steve, I mean, I might let you touch on a little bit more of that, but it's essentially looking at the asset class group scores page is the relative ranking of different baskets of funds that we have on the platform. And so then we're simply looking at the core equity percentile ranking. So the core, what percentile rank is your core equity market? And then what percentile rank is cash? Basically, if the core equity market drops beneath 40%, cash rises above 50% at the end of a month, then those models move to 100% cash exposure. There are some other models that we have that look at just the cash percentile rank. So if the cash rises above 50%, then those models will trigger into a defensive posture. If the cash rises above 70%, then those models that utilize that trigger will trigger into defensive posture. But I guess the long story short, in looking at all these various kinds of cash triggers, Steve, is that they all went back offensive with the latest evaluation. We had a pretty notable drop in the money market score and that cash percentile rank right at the beginning of this week, which led all of the models to go back into a fully invested posture, we'll say.
That's right. And let me make a backdrop to that, is that we found, or let's say, I've found, and those that have looked into this subject for many years have found that there's no one fund you can buy that's impervious to a particular market condition. There's no one index that can just, hey, let's just go buy an index and it will take care of itself forever. Those things don't exist. So what the fund score method has are several layers of defense that can come into play. One layer of defense is the relative strength in the first place. For example, if we're dealing with a strong fund and then it weakens up and another fund becomes stronger, we switch to the stronger fund. That in a way is playing offense, but it's also in a way playing defense. So relative strength is a level of how to defensively reorder the portfolio to better exposure. And then the other layers, like you just mentioned, we have several layers of cash that can be triggered in various ways. Each is needed because we want a way that's a little bit easier or quicker to come into play. And then we want a way that's a little more strenuous, maybe a double authentication, to come into play to go to cash. Because as all of us know, dealing with cash it does provide psychological benefits to clients. It does provide benefits to holding net worth and capital preservation. All these good words that cash can provide. However, in some cases, we want to not go to cash too quickly because sometimes the market's disturbances are over pretty rapidly. And, so we have different model breeds that, kind of approach the same, the same market, but they approach it differently. Many models had cash inside them because the money market itself was just stronger than other funds in the inventory. And many models had cash go into them because of the macro indicator which we call the money market percentile rank, which you just mentioned, got too elevated. And those models went into cash in March. So they've been sitting in cash since March. And then as we came into August, really starting with the last day of July, and then the first few days of August, all those days there, these various money market positions and money market indicators moved south. So they came out of the lineups. They untriggered their defensive red alert. And so, as you said, starting the last day of July and starting this week and including last night, those models that had any part of cash to them have all been released to be fully invested in whatever funds happen to have the highest relative strength. So that gives you kind of an idea that some models some models had cash components since March. And then now those cash components have been released and now we're back into fully invested. However, I will mention we have other models that didn't go to cash at all because they're looking at this double authentication in order to raise cash from any macro indicator point of view. The rationale behind that is the core percentile rank indicator, part of the double authentication indicators. It gives us readings, and it goes like this. If the market's core is strong just enough, we want to stay invested. We want to ride through the storm. It's going to be rocky, yes. It's roller coaster, yes. But if that core is strong enough, we give it some deference, and we stick with the relative strength game plan. Now, some people find that kind of a violent ride, but others feel that it's probably the best thing to do because the core of the market really is the reason we're in the market in the first place. And sometimes we find that the performances long term are definitely better to go with the double authentication method. So there are reasons to debate these things, but it gives you different approaches. And we have many clients that use model types. They use each of the model types so that they get a blend of some cash, mostly long, and have different triggers help them navigate. And so, there are different ways to use these together. But at this point, as we move into the week cycle of the seasonal cycles of August going forward, all the models are pretty much fully offensive, working with the best of the inventories that they have provided to themselves.
Yeah, and I think that the first point you touched on too, Steve, was pretty interesting with, the models had the separate cash triggers, which we run through, but they also had the potential, you can fluctuate in and out of a defensive posture just via the different members of the inventory, right? And we saw some models take a more, let's say, low risk approach after the May evaluation that are now looking at a little bit more of a risk on approach. Initially, just from a straight nomenclature and looking at it, we can see some of that reflected in the movement for some of the core solutions strategies. Specifically, there, the core solutions are looking at targeted kind of ETF inventories. So we have a core solutions US core model, and then a core solutions AllCap World. Basically, the US core model looks at a small inventory of just broad index focused US representatives. So like your NASDAQ 100, your SP low vol, your SP equal weight, your SP 500 broad SPY, looking at just broad representation there for the US core side, which did not see a change with the most recent evaluation. We did, so that model continues to be invested at a 50-50 split, holds two funds, currently SPLB and RSP. So no change to those rankings with this most recent eval. We did, however, see a change in the other one, the AllCap World 2S model, which sold out of the SPLV and bought RSP to now be at a 50-50 split between RSP, the S&P 500 equal weight ETF from Invesco, and then RPV, which is the S&P 500 pure value ETF from Invesco, those being the top two scoring funds in that inventory. So I thought that was kind of an interesting trade there, Stephen, in looking at it. I mean, we did see that model moved into low volatility, moved into SPLV right back in May in place of RSP. So RSP moved out of the model in May, and now it's coming back into the model. So from hindsight, we're like, well, that was a poor trade, right? But in looking at it, I mean, it did save you from a little bit of the downside over the past 3 months. RSP was down a little bit over 2% during the past 3 months. SPLV was down under 1%. So I mean, it did save you a little bit from that posturing there, just by nature of those score valuations, which kind of an interesting point to make.
Yeah, and the AllCap World inventory has a wider array of things it can do. You could say it can get hotter than the core U.S. core model, the other model that we just referenced, and it has the ability to work with what I would call higher beta types of inventory, which gives it some flexibility. I will point out that it's one of the best performing versions of AllCap World, or some of the best performing FSM models that we've ever had among the elite of that. And it's because of this flexibility to kind of dial up, dial back. And it depends on the market, because keep in mind, this is not human controlled as to what it buys. The score controls what the model invests in, and the score is directly tied to market conditions. So it's a soulless type of mechanism. Now, the moving back into the equal weighted S&P would be kind of a signal to say we're trying to dial up the general exposure to the general market and dial up the risk zone a little bit more than the low vol. To give you an example, a relative risk of a low vol ETF would be something like 0.83 to the market, whereas the RSP would be a 1.04 to 1.07 to the market. So we're ramping up the ability to be a little more aggressive, and then we go down the road with that, and then we work with just a little bit hotter volatility. So it's those abilities to move within the U.S. core to high vol, low vol, and the ability to move to mid caps, small caps, and offshore, which allow AllCap World to address different market scenarios over the years. And I think here, what we're dealing with, we're dealing with a core market in the U.S., which has been in various troubles, whereas the non-U.S. is in complete, it has been in complete trouble. So not really an option over the last months of 2022. So you're right. You could say, well, I wonder why it just moved out of here and into there. But these small moves can have big impacts. We really don't know, as much as we would like to know the future, we really don't know the future. So what we need to rely on are market trends, market metrics, and score type of algorithms to tell us, where is the puck moving to. And so, but I think it's a decent move with the AllCap World to increase exposure, ramp up to a small degree, or to a measured degree, volatility to participate with, let's say, whatever rallies or whatever forward progress the market may do.
Mm-hmm. Yeah, and I mean another in terms of inventories that are moving a little bit more kind of risk on from at least on the equity side of it. I mean, another one that springs to mind is the Rowe Price model, the Rowe Price lineup. That's kind of slightly so. The Rowe Price model, obviously Rowe Price being the mutual fund provider, we're taking the broad inventory from Rowe Price and then ranking them according to the FSM methodology and looking to hold 5 funds in this model, right? And so we saw some interesting trades kind of moving into some areas that have seen some strength. I mean, there were 3 trades in this model, Steve, and the one that jumps to mind to me was the health sciences kind of coming in. That's healthcare space has been definitely seen some near-term improvement in many of our kind of relative rankings or comparisons across the platform. And so it was pretty interesting to see that reflected in the score movement for the T Rowe lineup as well.
Yeah, and we see that in other families. Other providers, both mutual fund and ETF. This is very true. In fact, healthcare in general would be among, and biotech, which I could also couple in there as, the health sciences in general are among the best sectors of improvement, which we do catalog every day. But improvement over the last few months. And T Rowe, we have a financial services fund that really started to fall apart or wind down here as we closed July. And so the model kicked out the financial services and brought in the health sciences. So that kind of gives you the idea of how this pendulum can swing pretty quickly for how the fund score picks up, where we want to be. So the T Rowe's, got some good core, types of exposures, kicked out the financials, brought in the healthcare. It also did one more interesting thing. It brought in one fixed income related fund, and that would be the inflation protection fund that T Rowe has. It's a great fund from their point of view, actively managed. I do see other inflation protection funds that score well, but let me just make a point as we discuss this, is that fixed income in general has been working pretty well, picking up the pace since May. Fixed income in specific asset classes and tranches has been doing really well and still is right now. Inflation protection, government agencies, and so forth are among those kinds of things. And so keep in mind that the inventories of our models, in this case, a T Rowe model, do have fixed income selections that are scanned also. And they can also provide an asset allocation differential when we do a top 5, because if the fixed income funds are doing well on score, then we can choose them, and we just did. So you could think of T Rowe as 4 parts equity, 1 part fixed income. I think that's in line with what we're seeing in our macro indicators across the system, where fixed income is a greatly improved group, although you wouldn't think it would be. It has been. And the only way groups can improve really and substantially gain good scores is because they're in demand. There are buyers that are pushing these asset classes north. So those are things we have to contend with, because in this case, we deal with August as a quarterly selection, meaning that we have to, we're going to own this for August and own this for 2 more months after that. So yeah, just to give you a point of view, is that many of our models are asset allocation in nature, not equity only in nature. So T Rowe is a good example of that, and is also among the top performing FSM models historically.
Yeah. And I know we saw some, I mean, there are a lot of different kind of FSM models, so we don't have to dive into all of them, but we saw some pretty similar trades in the Vanguard lineup too, right? I mean, healthcare is another one there. You had inflation protected was another fund in that lineup that also scored pretty well. I mean, pretty similar looking movement between some of these fund providers.
Yeah, it kind of gives you that corroboration that this is not necessarily one active manager made something happen and it's not really there. No, this is more of a market-driven effect. The health sciences block. Some of these fixed income tranches. I also see, Ginnie Maes and mortgages, other things, that are strong. It just depends on the inventory and how those scores laid out. But it's nice to see some corroboration. You don't necessarily want a model that does things totally different than another model with a wide inventory is doing. You'd like to see that corroboration, and we do see it. So Vanguard is known as an index house, and Rowe Price is known as a one of the best active managers on the street. So you got two different types of shops there, two different types of houses, but the actual asset classes that they're dealing with have this underlying market presence, and that's bleeding through and triggering those score systems. So so I would say that they're very similar, and they end up being very similar. When we think about 4 parts equity, 1 part fixed income type of allocation, and then we're moving in through August, and they're on similar grounds. One an index based shop, and then obviously the other actively managed.
And I mean those two seeing similar movement. I mean, like the kind of confirmation, like you're talking about, is a good sign, but not every provider, I guess, saw the same movement. One kind of standing out from the pack a little bit, and I think maybe the final one we'll look at here. And again, just for listeners that might not be as familiar, there's a lot of different kind of models, a lot of different providers we'll look at. We just, for the sake of time, aren't going to hit on all of them here today. But definitely can reach out to us if you have any other kind of questions. But I guess the final one maybe that we'll look at here being American funds, right? I mean, again, we saw, I guess you could say, a move. It went back fully invested. This was one of the models that had exposure towards cash, towards our money market proxy, because money market was scoring high enough in the inventory that it came in as a 20% portion of the 5-member portfolio. So that moved lower, allowing room for the model to move back into a fully invested posture. It's just where it moved back into the invested stance isn't necessarily the same kind of places. More exposure towards the fixed income side, maybe, than some of those other lineups.
Yes. So let me take a backdrop and say that American Funds is an active team managed group. Has been around for decades and decades, and is a premier active manager in the realm of diversification, in some sense, a value slant to a lot of what they do. I often call them the best over diversified management company. Whereas a Rowe Price is very, very acute at being very focused and willing to take more risk, focusing down on fewer things. American Funds mitigates risks and widens out the exposures of their funds. What we have here, I think, this seasonal quarter is more of an outlier to what we have seen in the past from American Funds, and possibly and certainly an outlier to what we're seeing in some other models. And that is this. Is that a lot of their equity funds are fairly low scoring. As we came from February and we went into March and we got through May, and then we have a lack of strong scoring equity funds in this lineup according to Fund Score. But what we do have are some pretty good scoring fixed income funds. So the net effect of this is, in this case, we have our leading fund being an equity fund, American Mutual, which a lot of people would know. Excellent fund, value-oriented, high 4 score, but it's backed up by 4 fixed income positions that just came in. So, in other words, it's 4 parts fixed income, 1 part equity. So you could look at this as really trying to dial down the risk, bringing in lower relative risk assets, more fixed income based. As many of you know, American Funds has an excellent fixed income lineup. So here we have the situation where we're in a quarter, we're starting off the quarter, and we have a lot more fixed income than we used to have. Now, before one would say, well, that's a good move, a bad move, the right move, a wrong move. Again, we don't know the future. This could be a brilliant move. But what we will say is it's a little bit of an outlier from some of the other models that we have. And as you're, as a client or as you're interested, take a look at this American Funds portfolio. It's going to be much more lower on the volatility, or let's say the risk scale, than some of the other models are at this point in time. And that may be good, that may be bad, but at least you have American Funds, a quality team running that. So those are some of the things we've seen at this update. And I think that you just take it for what it is. Now, what sometimes we advise people to do is use all the models we just mentioned. By using them all, you get a little bit of that shop culture from different zones. Let's say one model has a lot more equity, another model has a lot more fixed income. But when you blend them together, you do get an asset mix that's pretty, I think, outstanding. And so you can always consider, as many of our clients do, to use multiple models for their clients and allocation. I just wanted to make that point.
Yeah, no, absolutely. I think that's a great point to bring. I mean, probably a great point to kind of wrap things up with as well. I mean, that's the beauty of the fund score method, the FSM models, or one of the beauties of them. And just like many of the other models we have on the platform, I mean, they're objective, they're rules based. The good thing about these, you know exactly when they're being evaluated 4 times a year or monthly, depending upon the model, most of them being that 4 times a year on the seasonal quarter basis. And then the models are just going to adjust wherever they see strength, right? So they're very flexible in terms of where they move. And just like you said, combining some of them together gives you a different kind of flexibility depending upon the model. It could arrive at that nice cumulative asset mix that they might be looking for there. So I know with this week's podcast, maybe a little bit longer than others, but we did have a lot of kind of changes to run through. But as we touched on, for those that might not be as familiar with these models, might not be looking out for them, they are available on our research platform. So if you're interested in learning any more about these models or about anything else we talked about here, please do reach out to us. You can either shoot us an email at dwa@dorseyright.com. You can give us a call at 804-320-8511. Or you can just go to dorseyright.com and take a look, a peek for yourself there, get a free trial of the platform or whatever you're looking to do to take a look at some of these models. So with that, Steve, I think that wraps up most of what we were looking to cover this afternoon. Thank you very much for joining us here, hopping on the podcast this week. Thank you everyone to tuning in this week, and we'll be back to talk with you next week.